One of these 8 habits alone can quietly cost the average household over $100,000 across 10 years. And almost nobody notices it happening. It's not one big mistake, it's small, invisible leaks, engineered on purpose, that compound while you're busy living your life. I'm Chris, and this is Boring Money with Chris, where we follow the dollars nobody bothers to follow. Today's episode matters because one of these habits, left unchecked for 10 years, can quietly cost a household more than $100,000, with nobody ever making one big obvious mistake. Let's start at number 8. Number 8, subscription creep. The average household is quietly paying for 12 or more recurring subscriptions right now, but most people, when asked, guess they have about 4. That gap is the trap. Streaming services, apps, cloud storage, a meal kit you tried once. Each one is only $9 or $14 a month, so small it never registers as real money. But stacked together, that's often $200 to $270 a month, leaving the account on autopilot. Over 10 years, with prices creeping up $1 or $2 every year the way they always do, that's easily $30,000 to $35,000, gone to services, half of which nobody actually opens anymore. Companies design this on purpose. Cancellation is buried 3 menus deep, chat support stalls you, and the charge date is picked to land right after payday, so the balance always looks fine. There was a case where a woman audited her bank statement for 1 month and found 6 charges for apps she'd forgotten existed, including a horoscope app from 3 years earlier. The telltale sign is simple. If you can't list every single recurring charge on your card from memory, right now without looking, you are almost certainly paying for something you forgot exists. Number 7. Overdraft and out-of-network ATM fees. A single overdraft usually costs $35. And here's the part that stings. Banks often process your largest transaction first, on purpose. So more of your smaller purchases bounce and rack up more $35 fees in the same day. Heavy users of this system pay an average of $250 to $350 a year, and a meaningful slice of bank profit, in some years billions of dollars industry-wide, comes from a small percentage of customers who overdraft repeatedly. Add in out-of-network ATM withdrawals at $4 to $5 a pop twice a month, and you're looking at another $600 to $750 a year just to access your own cash. Stack both over 10 years and you're near $40,000, essentially rent paid on money you already own. There's a well-documented case of a college student who overdrafted 5 times in 1 week because the bank reordered her coffee shop charges after her rent payment cleared, turning 1 mistake into 5. The telltale sign: if you've ever paid a fee just to see your own balance or pull out $20, the system worked exactly as designed. Number 6, paying only the credit card minimum. Here's the number that should stop me cold. Paying just the minimum on a $5,000 balance at a 22% interest can take over 18 years to pay off and cost more than $7,000 in interest alone, more than the original debt. The mechanism is simple and brutal. Minimum payments are calculated to be just enough to cover interest plus a sliver of principal, so the balance crawls down at a pace that feels like progress but mathematically barely moves. Card issuers profit enormously from this. Interest income is a huge share of their revenue, and the minimum payment box on your statement is legally required but still designed to look small and manageable. Run this across a household carrying revolving debt for 10 years, and total interest paid can realistically hit $25,000 to $40,000, depending on the balance and rate. There's a well-known case regulators studied where a borrower paid the minimum on a $4,000 balance for over a decade and still owed money, having paid the equivalent of the original balance twice over in interest. The telltale sign: if your statement balance barely drops month to month despite paying on time every single time, interest is eating almost everything you send. Number 5, store loyalty and rewards programs. This one flips the script because the trap isn't the fee, it's the spending it quietly triggers. Studies on loyalty programs consistently find members spend 10 to 20% more per visit than non-members, chasing points worth a fraction of a cent each. A typical rewards point is worth around 1 cent, meaning you'd need to spend $100 just to earn $1 back. Yet the psychological pull of almost enough for a reward pushes people to add items they didn't plan to buy just to hit a threshold. Multiply an extra $15 to $25 per grocery trip every week over 10 years, and you're easily $40,000 to $50,000 in unplanned spending, dressed up as smart shopping. Retailers know this. Point thresholds are deliberately set just out of easy reach, and expiring points create urgency to spend now rather than later. There's a documented pattern where members with expiring points spend measurably more in the final days before expiration, essentially donating extra revenue back to the store to avoid losing pennies. The telltale sign is that nagging feeling of adding one more item to get free shipping or hit the next reward tier. That feeling is the entire business model working on you. Number 4, buy now, pay later. Quick question for you. Have you ever split a $40 purchase into 4 payments just because the button made it feel free? That's the entire trap. These apps advertise zero interest, which is technically true, but late fees and the psychology of stacking multiple plans at once are where the damage happens. Users juggling 4 or 5 active buy now, pay later plans report losing track of which payment is due when. And roughly a quarter of users have missed at least one payment, triggering late fees that can run $25 to $34 each. Worse, splitting purchases makes people spend more overall. Studies show baskets are noticeably larger when a buy now, pay later option is offered at checkout, because $40 today feels smaller than $160 all at once. Do this regularly for 10 years, layering plans, missing occasional payments, and buying more than you would have paid cash for, and total added cost from fees and inflated spending can land between $15,000 and $25,000. There's a growing pattern of people using one buy now, pay later plan to cover the payment on another. A quiet debt shuffle that never shows up on a traditional credit report until it's already a mess. The telltale sign, if you genuinely can't say how many active payment plans you have right now, you've lost the thread. Number 3, extended warranties and protection plans. Here's the shocking part. On many electronics and appliances, extended warranties cost 15% to 20% of the item's price, while insurers and retailers only pay out on roughly 20% of policies sold, meaning the plan is priced to lose money for the buyer 4 times out of 5. Retailers love these plans because margins on extended warranties can run 50% or higher, often more profitable than the product itself, which is why the salesperson pushes it harder than the item you actually came in for. A typical household buying 3 or 4 of these a year on a phone, a laptop, a washing machine, a television might spend $150 to $300 annually on coverage they mostly never use. Stretch that over 10 years and you're looking at $15,000 to $25,000 spent insuring against problems that, statistically, mostly don't happen since manufacturer defects tend to show up early, inside the free warranty period, or not at all. There's a well-known industry pattern where the same appliance brand's failure rate sits so low that the warranty division is more profitable than the manufacturing division. The telltale sign, if the warranty pitch happens before you've even finished paying for the item, the math was built to favor the store, not you. Number 2, the daily convenience tax. Delivery fees, service charges, and small impulse buys stacked on top of each other. A single food delivery order often carries $6 to $12 in fees and tip on top of the food itself, sometimes adding 30 to 40% to the actual cost of the meal. Do that 3 times a week instead of cooking, and you're spending $900 to $1,400 a year on fees alone before counting the food. Add the daily coffee, the vending machine snack, the parking app surcharge, the convenience store markup on things that are cheaper at the grocery store, and a typical household bleeds another $1,000 to $2,000 a year in small purchases that each feel too tiny to matter. None of these individually feel like a decision. That's the design. Apps default to adding a tip and a service fee before you see the total. Parking meters charge a convenience fee for the convenience of using the app they forced you onto, and vending machines quietly charge 50% more than the same item at a store. Over 10 years, this daily drip realistically totals $20,000 to $35,000, all of it in amounts small enough that no single purchase ever triggered guilt. The telltale sign: if you couldn't estimate your weekly total spent on fees and small convenience purchases within $50, it's bigger than you think. And number one, the one nobody sees coming: lifestyle creep triggered by automatic plan upgrades. Every time your income rises, subscriptions, insurance tiers, and service plans quietly nudge you toward the next pricing bracket, and most people never downgrade back. Streaming bundles auto-upgrade after a promo period ends, phone plans default you into more data than you use, insurance renews at a higher premium tier without asking, and each one alone might only be an extra $10 to $30 a month. But because these increases arrive spaced out and disguised as your plan has been updated, almost nobody audits and reverses them. Financial researchers estimate that households who never actively review their recurring costs pay 15 to 25% more for the same services within 5 years, without a single deliberate decision to spend more. Stack that compounding creep alongside a raise that quietly funds a slightly bigger car payment, a slightly nicer apartment, and slightly more premium versions of things you barely notice. In over 10 years, the number can realistically exceed $100,000 in extra spending compared to someone with the same income who simply reviewed their plans once a year. There's a documented case of a household earning steadily more for a decade while their savings rate stayed completely flat. Every extra dollar absorbs silently into upgraded versions of the same life. The telltale sign: if your income has grown over the years, but your savings percentage hasn't moved at all, this is where it went. Here's the pattern behind every trap on this list. None of them rely on one big mistake. They rely on you not looking closely month after month, while small numbers quietly become huge ones. The fix isn't complicated, it's just rare. Actually reading the statement, actually counting the subscriptions, actually asking why the payment went up. Do your own research on the specific fees and plans that apply to your life. And for anything major, it's always worth a conversation with a professional who knows your full picture. Which one of these 8 hit closest to home for you? Tell me in the comments. And if this kind of thing is useful, subscribe. There's a lot more of where the money actually goes.